Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It was a consequential evening, let's put it like that, which basically gives us a lot to talk about in terms of what really matters for the market. Those letters have gone out. Love letters, whatever you want to call them. You've got mail, guys, right?
Oh, yeah. What a movie. Gosh.
Thank you for your attention. You've got a mail.
We are really the 90s kids. And Prashant is reiterating that and how, my God, used to be one of my all-time favorites. But anyway, more on movies and love letters later. The fact is that the news is out, but markets are actually not reacting too badly. I think they're still hoping that maybe there's scope for further negotiation.
Well, that's right. It appears, markets are holding on to that thread, going by what evidence we have in the last few months, that if it's too bad, then he pulls it back. So let's see how it goes this time around. But participation has been low. We'll talk about that in further detail in just a bit.
Absolutely. And room for negotiation. And generally, I think it's just one big hot mess in that sense. And let's just take it from the top, right, in terms of what you need to know as we start this session. So those letters went out. Trump's tariff letters went out, and they had unilateral reciprocal tariff rates. So one-way reciprocal tariff rates. Now, I want to make right at the top, I want to make a mention that there is no letter for India. Remember, we, of course, have been reporting, Parikshit has been saying for a while that decision on whether we will sign on that mini trade deal is in the next 24 to 48 hours. So we're still within, the time period of what we said. But in any case, there was no letter. And President Trump essentially said that they're close to making a deal with India. So India was called out specifically with regards to a deal. Here's Trump himself.
If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now, yeah.
Are the tariff letters that you sent today final offers, or are they negotiable?
More or less final offer. We've made a deal with United Kingdom. We've made a deal with China. We've made a deal. We're close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal, so we just send them a letter. If you want to play ball, you have to. This is what you have to pay. So as far as I'm concerned, we're done. We're sending out letters to various countries telling them how much tariffs they have to pay. Some will maybe adjust a little bit depending if they have a cause. We're not going to be unfair about it. And actually, it's a small fraction compared to what we should be getting. We could be asking for much more. But for the sake of relationships that we've had with a lot of really good countries, we're doing the way I do it.
Okay, so close to making a deal with India, that is President Trump himself. Now, let's get to the letters and the tariff rates which were announced yesterday. So, the simple point is these tariff rates look almost identical to the Liberation Day tariffs which were put out on the 2nd of April, right? I mean, there is very, very little change, except I think Japan, where the rates have moved up a little bit, and maybe another country where rates have dropped sharply. Otherwise, it's largely identical. I mean, you can just look at these rates and we'll put some of the important ones, the big ones which came through. There's not very much change. Those are the rates up on your screen. Japan 25, South Korea 25, Malaysia 25, Bangladesh 35 odd percent or so. There is some fine tuning. Now, I can't, for the life of me, I don't think anyone can really figure out what led to this fine tuning. By a percentage point, by 2 percentage points in some cases, slightly larger in for some other countries. But it is what it is, and those are the rates which actually did come through. The only new piece of information, actually, in a way, this is also not new because yesterday morning we were talking about how that 1st of August, when the new date when these tariffs will go into effect. We got to know this from Scott Bessent over the weekend, and we sort of put this out as like the de facto extension, the new deadline. So in a way, after all is said and done from last night, the only new thing was a 1-month delay. The tariffs are largely identical, 1-month delay with regards to the date of implementation, which is now the 1st of August. Now, is that also sacrosanct? We don't know. That could also move around. I think there was some indication, there was some talk with regards to that. Although President Trump in that bite, as you just heard, said, well, these are, as far as we're concerned, final offers, at least in terms of rates. Okay, now the letters also say that these tariffs are separate from any sectoral tariffs. So, sectoral tariffs for pharma, electronics, and many others which come under that Section 232. Treasury Secretary Scott Bessent was also on the record to say that we are going to have several announcements in the next 48 hours. This was yesterday evening. So now we're talking about 48 hours from yesterday evening. And presumably a deal with countries like India and others perhaps is what he's kind of referring to. Now I'll come to just very quickly wrapping up the market. US equities were down. S&P was down small. I mean, last session, S&P made a new all-time high. So we just sort of gave back a little bit. 0.75% down in the S&P. NASDAQ about 1% lower. The 10-year yield increased 4 basis points, about 4.38. Dollar index was up about 0.4. Oil prices were up 2% or so. So that's essentially the global picture. It's not really one way up or even down in that sense. There were many big single stock movers like Tesla and Capgemini and WNS, etc. And we'll sort of refer to those as we go along. Now to the market here. Yesterday was very, very quiet, and that largely was a theme when we started in the morning, same time, that expect the market to quieten down. And there were 2-3 factors that we put out. There was, of course, the Jane Street order and those players perhaps pulling back a little bit, but also generally expectations with regards to earnings, etc., being pretty muted. So, in a way, lack of triggers in that sense. So, yesterday was exactly that, except the FMCG space. The rest of the market was absolutely quiet. Now, not very much has changed in that sense, while we still await details of what will be announced between India and US. If something will be announced, these are levels, very near term. Support for the Nifty stands at the low of 25,331. Resistance on the Nifty stands at the high of 25,669. For the Nifty Bank, same levels. Support is 56,223, which is the recent low, and resistance stands at 57,628. GIFT Nifty will give you a quick sense of how we are kicking off trade this morning, which is down about 40-odd points. Sebi.
The market seems to be saying something. And the market seems to be saying that it's not too bothered. And a lot of these tariffs that have been announced, these so-called final tariffs via the letters, they're very similar to the original tariffs that were announced on the 2nd of April. It's not like there's a major climb down. Take Japan, for instance. The tariff remains at around that 25% mark. It was 24% earlier. It's 25% now. But the market is taking this in its stride. If you look at the Asian screens, all Asian screens are green. The Japanese market has cooled off a little bit. Yes, it was up 0.5% when it opened. Now it's up 0.1, 0.2%. But the headline is that there is no major market chaos across Asia. Markets are taking these developments in their stride. Now, you could argue whether it's because they think that the long-term impact will not be too damaging, or maybe there's a feeling that there will continue to be negotiation, and eventually over a course of next couple of months, maybe the tariffs come down. We don't know. But the reaction in Asia is fairly, optimistic on a morning like this, to say the least. By the way, the other facet is that in some way, if the US earns more via these tariffs, will it be good for the US? Well, that's what some commentators and the Treasury Secretary, Scott Bessent, seems to be indicating. Look at what he said yesterday. He said that we are taking in substantial tariff income and almost $2.8 trillion in tariff over 10 years. And that, he says, and other, market participants say, that could actually tide over the big, beautiful bill impact to a certain extent, fund the massive US deficit. And maybe that's some sort of a positive that the market is taking on as well. He also went on to say that he'll be meeting his Chinese counterpart in the next couple of weeks. So there's no shock and awe from these letters across markets. Even US futures for the time being right now, the Dow was down 1% yesterday, but down 1% after hitting all-time highs. So, not too much. US futures right now are absolutely flat. The markets are marching on. Let's come to India. Here, of course, we're dealing with a whole other set of issues beyond the global headlines. Like Prashant also mentioned, earnings, Jane Street, there's just a lot in the mix. Yesterday, the flows picture was positive, but the index could not make any headway whatsoever. Almost 2,000 crores of buying from domestic institutions. FPI is also for a change, but not selling at least. They bought total stocks worth a little over 300 crore rupees. We go back to looking at individual stocks because it's very granular. A lot of those updates are coming in. Titan is not sounding as optimistic as some of the other jewelers, which are posting 25-30% growth. Titan's jewelry business growth, domestic business growth, is 18%. So let's see how the stock reacts. M&M, June sales are up 14%. Production is still in the high teens, so the picture continues to look good. We've got numbers out of JLR as well, and again, they're not looking all that hot. In fact, there's a decline. JLR wholesales are down almost 11%, retail sales down 15%. So watch for Tata Motors. Naveen Fluorine is doing a QIP, so that's another stock that's going to be on our radar. So very, very stock specific. That's the way the market's been trending. And I'll round up with some headlines from the Sebi study. I'm sure it caught everyone's attention. So the numbers are still the same. The headline of the study says that 91% of the participants, individual retail participants in the F&O market, are losing money. That number's been steady at around 91% for the last several years that the regulator has done this study. What's changed this time is that the quantum of losses that individual retail investors are suffering, that has gone up, says Sebi. It says that now that loss in the last 1 year has gone up 41%. So at the end of FY25, which is when the study was done, an individual retail investor at an average is suffering an F&O market loss of over 1 lakh crores versus around 87,000 crores in the previous year's study. So, you know, they're still very, very cautious on the F&O market, as they have been, and that trend is intact. So just some food for thought there as well. But Nigel, what are you looking up for?
Well, I look at the Troika first to kickstart trade, and all the three, in fact, they had spiked up a little bit overnight. So you look at the yields, they moved to around 4.4%. The dollar index, strengthened a little bit. And also you have Brent crude prices that moved up, despite the fact that OPEC Plus, they released a higher than expected production into the market. The one that I'll be looking out for is the yields. The last thing you want is for the yields to go dancing away to around 4.55, 4.6% odd. And as we saw last time around, that's the one that actually breaks the back of the market. So we'll keep an eye out on that. The dollar index, after spike up, actually has cooled off a little bit. All three still not no worries on that front. But the point I wanted to make with regard to participation, just take a look at the participation yesterday, and if you compare it with the averages, the last couple of trading sessions, the volumes have been very, very low in comparison to what we've seen on average. So normally we have more than 1.1 lakh crore worth of value trades on the NSE. Last couple of days, in fact, yesterday, it was sub even 80,000 crores. So we'll keep an eye out on that. For the time being, it appears participation has been very, very low. Couple of holidays in the Western world, Canada, as well as the United States. That could be one of the problems as well out there. What did the FIs do? Well, they added closer around 5,000 short contracts, while the clients, they did the opposite. They added closer around 5,000 long contracts. And if you look at the positioning, there is some shorts in the system now, because when we started off the series, the FI net short positions were only around 30,000 contracts. That's at least moved to around 70,000 contracts or thereabouts. Normally, the number you look at is around 1 lakh net short contracts. That's what gives the bull some kind of hope, because that could be a bit of a squeeze that takes place. In percentage terms, more than 70% of the positions from the FIs are on the short side, while you have the clients, well, they are net long, but closer around 57% of their positions on the long side. We should get the options data that comes up for you on the screen. The call writers, they're getting very, very confident now. The 25,500 call yesterday added another 20 lakh shares or thereabouts, while on the downside, that 25,300 put, that as well was fairly active. So just plugging in the levels, going by what we saw in terms of call writing, this 25,600 mark, this becomes the near-term resistance mark. So we'll keep an eye out on this one. And in terms of support, the options data suggests that this 25,250, which earlier was the resistance zone, that will be one level of support. And the recent low is in this vicinity of around 25,332. So that's going to be the important range you want to see supported on the downside. You don't want that level to get breached. Index I'm looking at is obviously the FMCG index. Well, that yesterday did quite well. There's a debate whether or not there is actual recovery on ground. But at least in yesterday's trading session, what you saw was it ended closer around the 50 DMA and it conquered the 20 DMA. So let's see whether or not it has more legs out there. But besides that, we'll keep an eye out even on the Nifty Bank. And, that's the FMCG index, basically, with the levels coming up for you on the screen. But since tariffs have been put on other countries, you also could probably look at textiles because of the tariffs that are imposed on Bangladesh, maybe the paper industry as well because of the tariffs that have been imposed on Indonesia. So stock-specific action will continue.
All right, no, absolutely. And, we'll keep an eye on many of these names as trade starts and kicks off today. Cameron Brand is with us, Director of Research at EPFR Global. Cameron, great to have you with us on the program. Good morning. So markets, of course, have been around the world, actually, have done quite well. US, of course, really the leader in that sense, despite last night's slight pullback. So, in a way, unbothered with everything which is happening with regards to tariffs, etc. There was that one-time shock around April, and the markets did dip quite a bit, but they're back, and how? What are flows telling you, Cameron, globally and specifically with regards to India?
So the flows are telling us that investors are certainly happy that this is the case, but they don't really have great faith in it. Certainly in terms of the U.S., they are not chasing the latest leg up in the market. Ditto for China, where the latest stimulus measures, monetary easing, has had no real effect on the sort of slow outflows that we witnessed for most of the year. Investors do seem to basically be positioning themselves for a reasonably soft landing. They're loading up on higher funds that offer exposure to higher yielding debt. I think the assumption is that those yields will go down as the U.S. and other economies weaken. I think the main sort of note that I think may have changed a bit is that though markets are certainly behaving as if any landing will be soft, there seems to be a sense that once certainly the U.S. economy has landed, it won't be a short turnaround time, that you could be in for a period of slower growth.
Cameron, hi, good morning. The markets are
Good morning.
Good morning. They're completely unfazed, and that's the point you were just making, that a lot of the tariffs that have been announced in these letters, they're pretty similar to what was announced on the 2nd of April. But the markets are seem to be comfortable, 25% for a lot of Asian trading partners, 35% for countries like Bangladesh. What's the sense? I mean, and data out of the US is still very, very positive. So is the market actually getting it right versus the economists?
Yeah, I mean, I think the market tends to react on what is rather than what might be the worst case scenario. And, you have the history of the first Trump presidency to sort of base, at least some predictions on. And that history is of fairly protracted negotiations that usually end up well short of the opening salvo. So no, that said, I do think that markets, I'm beginning to wonder what really will move them in a sustained basis. There's been a series of things from Iran and Israel exchanging missiles to the big, beautiful budget bill, which, if you're a deficit hawk, is not beautiful at all. And then, the markets get moved for, 4 or 5 days, even 2 weeks, but shrug it right off. So
Sure. But Cameron, on the flows, when all of this began in April, there was suddenly a big sort of chatter around de-dollarization, moving away from U.S. assets, and we saw that play out in some of the Asian markets, for instance, getting more flows. What evidence do you have from the latest data in terms of just how is money moving, and if you have any estimates or projections of what we may see in the near term?
So, it continues to be mildly positive for India, which I'm guessing is what you really want to hear about. Pretty much since the de-dollarization theme emerged, dedicated India funds have really seen steady inflows that fell well short of the banner period between 2023 into last year. What I think is positive both for India and emerging markets is that investors are showing a preference for diversified exposure, especially on the equity side. Global equity funds have done well for a while, and we're starting to see a significant pickup in flows to the global emerging markets funds, which still have a very healthy allocation to India. You circle back to my earlier comments, what theme really is going to stick with markets? It seems even the de-dollarization theme for the moment has run out of steam. But it's resonated enough that there's certainly been a modest but appreciable rotation towards the stronger emerging markets. India and Korea and Brazil, I think, have been the main beneficiaries of this.
Okay, all right. Cameron, great speaking with you. Thank you very much for your time. Appreciate your thoughts here on CNBC, as always. Well, what we're going to do is take a quick commercial break here. We'll come back and focus on individual stocks, which should be in focus. And there is a list, and our research team will run you through that as we come back. But, here are some of the interactions which are lined up on the program today. 8:35, we have Gurmeet Chahal of Digitized Solutions joining us to discuss the quarter gone by. Their F526 outlook. Of course, there's that big deal as well, Capgemini WNS. We'll talk about some of that. 9 o'clock, we'll have William Lee of the Milken Institute to talk about the Trump tariff letters, which have gone out. 9:20, Gautam Dugat of Motilal Oswal Financial Services on markets. 9:30, Astra Microwave Products will be with us. Outlook for F526. Mayank Shah of Parley Products and Vishesh Dora of Bizom will be speaking with us on consumer trends. Remember, the FMCG index did quite well, the only index which did well. 9:50, it's our special segment, Quarter Se Quarter Tak, and we'll put the focus on, of course, what's first off the block, which is the IT sector as far as the first quarter earnings go. Towards the end of the program, it's the economy. Lata speaking with Robert Subramanian of Nomura and Chandresh Jain of BNP Paribas to discuss the impact of Trump's tariffs on EM economies, currencies and rates.
Well, time to a quick break. We've got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Top 10 segment. For the time being, I'll run you through the list. Tata Motors, Kotak Mahindra Bank, Macrotech Developers, Phoenix Mills, Soba, JSW Infra, and Textiles Stocks. They'll all be on our radar on the back of positive news flow. Titan and Navin Fluorine will be reacting to negative news flow, while we get a mixed reaction coming in on the crude sensitives. Take that break, come back, further detail on all of these names.
Welcome back. Well, as we've been telling you, the reaction across Asia is actually very, very sanguine. You're not seeing any major deep cuts or anything of that sort. In fact, there's a fair amount of green across Asia this morning as the markets are digesting the tariff letters very, very well. It's going to be a lot about individual stocks, including sectors like textiles, perhaps, that stand to benefit given where the tariffs for countries like Bangladesh and Vietnam are landing. Let's see. Implied Open is saying we'll start soft and then we'll pick it up from there. Let's talk about individual stocks, though, and our team is standing by, as always, with the CNBC-TV18 list of top stocks to watch. Lots of updates coming in for the quarter. Sudarshan, morning. Let's start with Tata Motors. Still not looking good.
That's correct. So Tata Motors has reported Q1 sales volumes, both wholesales and retail volumes for JLR. And while sales have declined both on a sequential basis and year-on-year, but company is saying those sales are largely in line. So wholesale volumes have fallen by almost 11%, while retail volumes are down more than 15%. And most of the major markets except China have seen a decline, with Europe and US seeing a fall in the range of 12 to 14%, while UK, because of winding down of legacy Jaguar models, have seen a fall of more than 25%. Now, MS has come out with a note on that. It maintains equal weight call on the stock and says strong mix helps partly offset weak volumes and tariff headwinds for JLR, and it believes that company is likely to report an improvement of almost 8% sequentially in average selling price, and on the margin front, it's expecting 11.4%. So the reason company is saying that despite a decrease in the sales volumes, those sales are largely in line. I'm going with green for Tata Motors.
All right, going with green for Tata Motors. Got that. Thanks, Sudarshan, for that. But Mangalam, you're going with red for Titan. A little softer than expected.
It is softer than expected, and more importantly, it's softer than what the peers reported as well. So if you bid up Titan yesterday thinking that, the way Senco and Kalyan Jewellers reported, you'll be disappointed today, because the domestic jewelry business for the Titan company grew just 18%. Remember, a couple of weeks ago, we had a brokerage which was estimating around 20 to 21% growth in the first quarter, led by Akshaya Tritiya. But remember, it's the gold price volatility which has affected consumer sentiment. That's what the companies alluded to. And more than that, even studded ratio, that was lower year on year, as demand for plain gold growth grew in high teens, whereas you had studded segment which grew in early double digits. So that's, margin dilutive. At the same time, buyer growth was absolutely flat year on year. There were some green shoots in other segments, like watches grew about 23%, emerging businesses led by fragrances and women's bags grew 38%. There was strong growth in Carrot Lane as well as the international business as well. But the mainstay of the company, the jewelry business, did not grow as well as expected and did not grow as much as the peers did as well. So to see some red on Titans in today's trading session.
All right, Mangalam, thanks very much for that. Let's talk about Kotak Mahindra Bank as well. Gaurav is here with details. Gaurav, morning.
Well, yes, Kotak Mahindra Bank definitely is going to have a great day today, and the reason being that they have actually reported good set of numbers in terms of advances. 14% growth is what we have seen. Even 4% on a sequential basis is a strong growth. Let's not forget that industry is growing at a rate of around 9 to 10%, and in this environment, Kotak Mahindra Bank is coming up with such growth. Let's also not forget that when we compare these numbers with the consensus, there also we are seeing that these numbers are higher than consensus. In terms of deposits, there also we are seeing 14.5% of growth on a YOY basis. Now, this is actually driven specifically from the term deposit side because CASA has seen a little bit of softness, but this is actually a trend in Q1, and that is the reason why this is not a concern for Kotak Mahindra Bank, at least for now. We will be watching out on what segments have grown during their results, but definitely for now, a good set of number from Kotak Mahindra Bank for provisional updates.
Okay, all right. So Kotak Mahindra Bank looking steady in the first quarter. Got that, Gaurav. Thanks very much. More updates coming in from a bunch of real estate companies. Sonal, tell us more about this morning.
Good morning. Well, let me start with macro tech developers. They have seen a growth of around 10% in the quarter gone by in terms of their sales. Now, remember, they had guided for a 20% growth, so it's lower than that. In terms of collections, it's up 7%. However, the company says they are on track to achieve their guidance of 26,000 crore rupees in terms of sales in FY26. They're also talking about collections in second half to be higher than their first half. Phoenix Mills, it was decent consumption in their malls business, up 12% on a YOY basis. However, the trading occupancy came in lower on a quarter-on-quarter basis. That is because of some shutdowns that they had taken, and this was a planned vacancy that they are talking about. For Soha, again, it was a double-digit growth in their sales. Their sales were up 11% at 2,079 crore rupees. Sales volumes were up 27% as well. And this is the highest ever quarterly sales number for the company. So looking good for Soha as well.
Okay, all right. Thanks a lot for that, Sonal. Going to Vivek now to tell us about Naveen Fluorine, who's doing some fundraising, and JSW Infra. Morning, Vivek.
Well, good morning, Naveen Fluorine. Last evening they launched a QIP for a fundraise. The company is looking to raise close to 750 crore via the QIP route. And as per the term sheet that we managed to access last evening, the indicative issue price is at 4,680 rupees a share, which indicates that there is a dilution of slightly over 3.2% of the total pre-equity dilution. Now, what is the company raising the funds for? Number one, debt repayment for both Naveen as well as one of its subsidiaries, and the remainder of the funds will be used for general corporate purposes. Now, coming to JSW Infra, remember last week we had the management on a channel where we quizzed them about getting the license as far as the Kolkata port was concerned, and along expected lines, the company has received the LOA for 2 berths at the Netaji Subhash Dock of Kolkata Dock System. The project has been awarded on a design, build, finance and operate transfer, 30-year concession period, capex estimated at 740 crore. Total capacity as far as handling of volumes at this particular terminal would be close to 1 million TEUs. Now, the company said that this is expected to be an accretive, acquisition as far as the port volumes are concerned.
All right. Thanks very much, Vivek, for that. Now, textiles should also perhaps be in focus, of course, with regards to textiles here in India, which is a labor-intensive sector, which, of course, the government's been very mindful of. It's come up in our reporting with Parikshit as well on this potential trade deal, mini trade deal with the US. For now, I guess we're looking at some of the tariffs imposed on countries like Bangladesh, which are big competitors. Vinny's got details. Vinny, morning.
Hi, good morning. So yes, we're keeping an eye out on all these textile stocks today. So obviously, last week the announcement came in for the Vietnam tariff from US and Vietnam that was imposed at around 20% tariff on textile. Now, Bangladesh also in the recent announcement that has come in, updated tariff is at 35%. On April 2nd, it was 37%, so slight reduction there. What we're watching out for is also China. They had already been imposed with a 55% tariff. Now, India currently faces 10% tariff overall on all goods, but for textile, it's 26%. What does it mean for India in terms of Bangladesh, Vietnam, China, where these are big competitors for India in terms of importing or exporting to US over there? So these are big competitors there. So what it means that if, as of now, there's no deal that is announced, but we are expecting a deal coming out soon, tariff lowered would give us a competitive edge over all these countries, whether Vietnam, Bangladesh or China. But if tariffs are kept at this 26% mark right now for the textile sector, then we would lose some bit of a competitive edge over Vietnam, but over Bangladesh and China, the competitive edge would still remain. Possibility of market share gains. So obviously, there's 35% on Bangladesh. We are expecting, textile stocks to react positively in today's trading session.
Okay, all right, Vinny, got it. Thanks for that. So textile stocks on our radar as well. Let's also talk about crude oil and how that may impact today's market sentiment. We have Manisha joining in with the latest updates here. Manisha, morning.
Morning, and thank you for that, Sebi. Pardon me. The crude oil prices are trading at a 2-week high. We've seen 2% of gains in the overnight market there. Well, remember, there was a knee-jerk reaction to the lower side after OPEC Plus increased output by 548,000 barrels per day for the month of August. Now, this brings in 80% of the 2.2 million barrels per day of a cut. Having said that, the markets believe that there is demand in the near term, and that has been supportive is the reason you're looking at the crude oil price is trading around that $70 a barrel. Also, Saudi Arabia has raised August prices for Asia for a fourth straight month to a 4-month high. So that tells you that the demand even at these levels, even with the tariff concerns going on, has been on the stronger side, and that is keeping the crude oil prices on the higher side.
Okay, all right. So we'll watch out for the crude sensitives as well. Manisha, thank you very much for that. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow would be, actually Tata Motors will be on the negative side because of the JLR sales. Then there is Kotak Mahindra Bank, Macrotech Developers, Phoenix Mills, Soha, JSW Infra and Textile Stocks on the back of the tariff developments. On the negative news flow side could be Titan, Navin Fluorine. Crude sensitives could see a mixed reaction in today's trade. Okay. All right, so that's on the stock list front. But now let's address that really interesting study that came in from market regulator Sebi on the derivatives market, which shows that retail traders lost over, that's at an individual level, every retail trader at an average saw a loss of over 1 lakh in FY25 on derivative bets. The quantum of losses has gone up significantly in Sebi's study that was conducted for FY25. Hormaz is here with more details. Hormaz?
Every possible adjective that you can use in that Sebi study. There are certain things that have gone from bad to worse. There are certain things that have remained constant, and there are certain things that have improved as well. Let's start the big number first is that the overall loss in FY25 that the retail traders made in the F&O market, over 1 lakh crore rupees, and that is a 41% jump from the loss of around 74,000 crore odd that they had made in FY24. So that is the big number that comes up in the study in comparison to last year. And of course, the trend that has remained constant is that in the previous study as well, 9 out of every 10 retail traders in the F&O space made losses. That number remains the same. That 91% figure remains constant, as has been the case over the last 4 years as well. But if you take a look at the quarter-wise trends in FY25, although the things in the first 2 quarters go from bad to worse, there is a sequential decline that is being witnessed in between the third and the fourth quarter of the year, and that is because of the measures that were put in place by Sebi in November of 2024, which has had an impact on this. Now, the number of traders and the loss made by the number of loss-making traders both have declined on a sequential basis in the third and the fourth quarter. And even the average loss per trader, if you see that in the third quarter, that comes up to around 63,000 rupees. That has come down to 58,000 in the fourth quarter on a sequential basis, although it is still higher than the losses that were witnessed in the first 2 quarters. And even in the number of traders list, if you could see, the number of loss-making traders too has seen a decline on a sequential basis. But despite all of this, India continues to remain a very highly traded derivatives market according to the Sebi study, and that is evident from the 5-year CAGR that you see, whether it be in the index options premium or in the stock options premium, even on a notional basis as well. The index optional premium on the notional basis, the 5-year CAGR has doubled. So that shows the kind of activity that you have seen in the derivatives market, and the measures that Sebi had put in place has shown its effect across categories. Now, the number of unique traders has had the biggest impact in the sub 10,000 rupees category, where the number of traders has declined more than 30%. And even in the other categories, the losses are up to 1 lakh rupees too, has seen a loss or a decline of around 20% from last year. And even on the 10 crore plus category, that has seen a decline of 11% in the number of unique traders. So interesting analysis coming in from Sebi. The one thing that remains constant, 9 out of 10 retail traders still continue to make losses.
Okay, all right, Hormaz. Thanks a lot for joining and giving us that quick update. For the time being, though, we'll slip into a short break. On the other side, we'll be joined by Gurmeet Chahal of Digitized Solutions We'll be discussing the quarter gone by, the outlook for the next year, and also potential repercussions of the deal that we saw overnight with regard to WNS. Stay with us.
Welcome back. Digitized Solutions is on our radar. Now, the company recently demerged the entity of Quest Corp, focusing on AI-led digital solutions. The company is betting on AI-led transformation and is eyeing 3x revenue growth by FY31. Let's talk about this and their overall business plans with Gurmeet Chahal, Chief Executive Officer and Executive Director at Digitized Solutions. Mr. Chahal, thanks very much for joining in. So, let's just start there. When you say that the focus is going to be on AI-led solutions and you could be looking at some more investments over there, what is the plan, and the near-term plan that you perhaps have in mind?
So, first of all, Surbi and team, a very good morning, and thank you for hosting me. So, look, for us, AI is the big bet. And the reason we are taking that bet is we believe AI is going to be value accretive for us. On one hand, it helps us to optimize the cost. On the other hand, it opens a lot of new opportunities and frontiers for us. So that's where we have taken a big bet on AI. We've invested in senior leadership from the industry. We are building our own platforms, and then we are partnering with some industry leading product companies. The approach we are taking, Surbi, is a threefold approach. I call it the three-lens approach. Lens number one is the lens of industry. So we will have AI for insurance, AI for banking, AI for healthcare. So that's lens number one. The lens number two is the lens of the process. So AI for customer care, AI for HRO, AI for F&A, AI for software development. Third is, which is most interesting, is the persona lens. So AI for CIO, AI for CTO, AI for CFO. So that's how we are making investments.
All right. Hi, Mr. Chahal. Good morning. Good to see you. Ben, just let's get the numbers out of the way. I'm looking at your ambition with regard to profitability and return ratios as well. You have mentioned you're looking at 200 basis point margin expansion, in the next few years. Could you tell us what would it look like in absolute terms? Because your last year's numbers for the year, I think they were close to on 14%, but for the quarter, they were close to on 11%.
Yeah.
So this 200 basis points expansion takes the margin number to what? Point number one. Point number two is you're looking at scaling a business big time to $1 billion. Could you tell us on the core business, that's the current business, how much will the contribution be? Should we look at around 750 million and 250 million of inorganic? Could you split that up for us?
Sure. So you've got two questions. First, on the margin expansion,
Yes.
the 200 basis point that we are saying in the 3 to 4 years is with respect to the 14% that we were at. So we are looking at 16 to 17% margin eventually. As we stated in our Q4 commentary, we are also looking at optimizing our portfolio. So we are getting out of some non-core business, and as a result, 1 or 2 quarters we expect the margin to be dipping as we do the cleanup. In parallel, we are also making investments, investments as a standalone company, investments in leadership, investments in some offerings. So in the short term, that's where the margin came down. But in the long term, we are looking at the 16 to 17% margin. So that was your first question. The second question, so look, when we will be $1 billion company, think of it, we have to add about 650 million incrementally from where we are. So we believe roughly about 200, 180 to 220, roughly 200 will be through inorganic. The remaining will be organic. Traditionally, we've been growing at about 14% CAGR. So that means organically, we have to grow at about 16%. We are very confident given all the investments we are making. And for inorganic, we are already looking at certain segments that we believe are aligned with our investment thesis, our growth thesis, and are adjacent to where we play today, and we have a right to win.
Okay, Mr. Chahal, you've also indicated that there is going to be a ramp down on several non-core low-efficiency businesses, and this happened, over the fourth quarter. How long will these ramp downs take? What will they mean in terms of loss of revenue, maybe improvement in profitability because they're perhaps low-margin businesses? And what will the implications be? Also on the AI front, yesterday we saw the big deal between Capgemini and WNS. So what does that indicate? Standalone BPOs, is AI a real threat? Just take us through, the contours of how the company is going to look like a year down the line when you complete some of these structural changes.
Yeah. So I think, look, why are we making these structural changes? See, today about roughly 70% of our business comes from BPM. 30% comes from technology, data, and AI. We want that 30% to be 40%. Secondly, we want our international revenues to grow from currently 40% to 50%. Okay. So the investments that we are making and the portfolio optimization is aligned to this direction, and we believe, this is where we can add more value. Coming back to your second question, look, yes, it's a marquee deal, WNS and Capgemini. The way I look at it, I think it's not about a standalone BPM as much. I think it was for Capgemini to add a BPM capability so that they can effectively compete with the likes of Accenture. In fact, I read an article where they're saying, hey, now they can also compete with the big four. So I think it was adding a capability, BPM capability. And look at the premium they've paid. So BPM is not going anywhere. The form and shape of it will change. And that's why we have gone all in on AI and we are getting ahead of the curve. Just to give you an example, when we declared our Q4 results, we did give this detail. Our customer lifecycle management business grew 16% year on year. However, there is a lot of AI now getting built into that business. We have developed our own agentic AI solution called QBuddy, which is coexisting with our human agent. So it has made it more efficient. That's why companies are seeing more value, and we are getting a lot of business in that segment.
Okay, all right. So looking at transformation and looking at scaling up on some of these businesses. Got that point, Mr. Chahal. Thanks very much for joining in, and we look forward to more conversations in the future. Thank you for being with us. Well, with that, let's move on. Amnish Agrawal is joining in to talk about fundamental stock ideas and, of course, individual names that would be in focus today. Amnish, good to have you on. I want to start with textile stocks because the numbers are, at least right now, looking very, very favorable. We have a 10% levy on our exports to the US. Vietnam is at 20%. And a major rival market like Bangladesh is at 35%. China is even more. So even if the 10% levy continues, this could be a huge advantage for textile players, won't it? Do you like any stocks here, apparel and textiles?
The main thing is we need to be first clear what are the ultimate tariffs going to be. Yeah. Because you never know that today it is 10%, next day morning we get up and it is 25 or somewhere it is 30. So all these are very interim things till the time the trade agreements are there between US and some of the other countries. So we can't rely on these tariff numbers just to buy these stocks. So that is one. Secondly, as far as your exports are concerned, I think we have Gokuldas, we have Wellspun. So there are a few companies which are actually doing all these exports. In particularly your home textile and bed linen, India has been competitive and the competition from Bangladesh and some of the other countries, that has been more in case of your apparel. Okay, where due to the duty advantages and the, you can say the most favored nation status from US and Europe, or Bangladesh had a huge advantage over India. So I think just because of this, you can say news, I will not tend to buy the textile stocks. Let the things settle. Let the duty structure be clear over the coming few months, because there can be, you can say, very wide variations in the duty.
No, okay, I take your point, Amnish. I take your point that we never know with these tariffs. Any day can be a different day. But intrinsically, like you mentioned, Wellspun living on the made-up side and the fabric side and a home textile side, or a Gokuldas on the apparel. Intrinsically, X of tariffs, just looking at business efficiency, valuations, margins, which of these companies do you like, if at all?
You see, Wellspun has been under pressure in the past few quarters, whereas Gokuldas has done well. So I think that there are many, you can say, factors at play. One has been the soft demand in US, and secondly, the margins have been under pressure. So, for example, Wellspun has rallied from something like 110.15 to 145. So till the time there is clarity, I think I would tend to be, it's more like sideways kind of a counter for me. When it comes to, say, Gokuldas, yes, the company has been doing well. But given the fact that it has risen significantly over the past few months, I think at the current juncture, I would tend to avoid any of these counters for fresh investments.
All right. When you talk about Wellspun India, since Wimbledon is going on, you can't take your eye off those towels, which are made here in India. But we got your view on the textile stocks. Let's talk about FMCG. Amnish, what is your view? We have Titan's numbers that have come out. And actually, if I compare it with some of the peers, it's looking a little bit softish. Maybe a couple of one-offs, maybe the high price of gold as well. Your view on Titan as well as the other jewelry names?
Nigel, we have to look at it in two ways. One is absolute growth, and the second is your same-store sales. If you look at some of the, you can say, names, say, which have grown faster than Titan, there the store additions have been far more. So, for example, in case of Titan, the growth rate is, say, 18%, and the store additions are hardly, say, 1% of the total. Whereas some of the other names, the store additions are even, say, accounting for 10-12% of the total numbers. So while, yes, there are a little soft relative to others, maybe by you can say a couple of percentage points, the gap is not that much if you look at on a per store basis. So that is one. Secondly, in case of, say, entire jewelry space, the last 1.5 months, beginning from middle of May, it had seen very sharp spike in gold prices. So that is one reason that there was some softness in demand during that period of time, which now I think might be better, because in the last 15-20 days, gold prices have corrected by a few percentage points. So I think these are all temporary sort of, say, variations. For example, despite all this, Titan has very strong sales in watches, and the company can post 18 to 20% PAT growth in this particular quarter. So I think while the stock has run up quite sharply from 3,150 to 3,200 to the current levels, I think I don't rule out a little bit of, say, correction. In the long term, yes, it remains to be a good stock. But I think valuations for all the jewelry companies, they are reasonably rich at this point of time.
Okay. All right. Got it. Amnish, request you to stay with us. For the time being, we slip into a short break. We continue our fundamental chat with Amnish. We'll also be joined by Sudarshan and Vitesh. They'll be helping us out with their technical calls on the market. Welcome back. Well, as promised, Sudarshan and Mitesh are with us to give us their check on the technicals. Good morning, gentlemen. Good to see you all in as always. Sudarshan, you go first. Yesterday, what was standing out was volumes were extremely tepid here in the Indian markets. In fact, if I look at the US markets overnight as well and compare it with the 20-day average, volumes are relatively lower. What's your view in terms of market action from here on? We appear to be in a bit of a range, but how would you trade it?
Yeah, good morning. See, we are in a trading range, but the difference this time seems to be that every time we were in a trading range, the markets would try to go up hit the resistance levels, and eventually break out on the upside. This time, the range is doing the exact opposite. The Nifty is in a narrow range. It's not coming down. It's not going up, but it's hitting the lower support levels repeatedly. That's worrying. Now, this could be a one-off event. It may not mean much. But at this point of time, I'm not upbeat on the markets for the short term till we break some significant resistance levels, 25,600, 25,650. Till then, I would say avoid the Nifty completely and focus entirely on stocks. I am not, after a long time, so upbeat.
Okay, not so upbeat. Got it. All right, Sudarshan. Mitesh, what about you? How are you feeling about the markets?
Good morning, Nigel. So, this market has been what I would say is going through a contraction phase. And the next directional move will take some more time to build up. Now, whether it will be on the downside or on the upside is mildly difficult, though I think there is no reason to worry about a big downside move. But, the idea is that post a contraction, a breakout or breakdown can happen in either direction. So we are waiting it out. The key level to watch for me on the downside is 25,200. As long as we are not breaking that, I think we're pretty safe. Only if we start trading below that, would I be worried on the downside.
Got that. Gentlemen, morning, Mitesh and Sudarshan. Mitesh, what would your trades be?
Morning, Prashant. I have a mix of buys and sells. FMCG was a strong performing index yesterday. So Britannia is a buy with a stop at 58.30 for targets of 6,000. Cummins after consolidation appears to be breaking out. So buy with a stop at 3,400 for targets of 35.20. A sell on Hudco with a stop at 232 for targets of 218. And a sell on HDFC AMC with a stop at 50.50 for targets of around 49.
Okay, and Sudarshan, what about you? What do you have for us?
Well, I have a mix today, and that tells you that I'm not very sure about what the markets will do. Bharti Airtel is a positional buy. Despite the significant rally, I think there is more upside. Consider buying with a stop under 1989. Hindliver, that big move yesterday tells us that some kind of a breakout has happened. I can't say if it sustains, but on a small dip, it's worth buying. Buy Hindliver with a stop under 23.60. I have two intraday shorts, Tech Mahindra, Techem, intraday short with a stop above 16.53, and Naukri, which is Info Edge, an intraday short with a stop above 14.59. So it's a mixed bag.
Okay, all right. Thanks a lot for that, Sudarshan. Well, I'll tell you what, we'll slip into a short break. You come back, we'll be due for pre-open rates. We'll also get chatting with William Lee of the Milken Institute to talk about Trump's tariff letters. Stay tuned for that conversation.
Okay, welcome back. There's 16 minutes to go for the market open, 2 minutes to go for the pre-open session, and we'll of course pick up on some of this stuff as things start to trade. The next 24-48 hours will still once again perhaps essentially we may get one more round of news flow with regards to a deal, and we've been saying this, that the markets are largely unbothered, but at a slightly, if you pull back a little bit, the fact is markets have done phenomenally well, and the question is whether some of this tariff bit eventually is going to start to feed into the real economy. And I mean, around the world, tariffs are substantially higher now. I mean, I think average US tariff rates are about 14% as compared to 2-3% when Trump actually took office. And of course, they are expected to go even higher, maybe north of 15% average. And of course, then there are specific deals, etc. So this is a space, I think, where we'll have to wait and watch for more. Amnish is still with us with what he's making of things and what the sense is. Amnish, thanks for waiting. I'm kind of sure you wouldn't have a view on any of these names, but let me throw them your way in any case. These are all kind of, in a way, penny names, but they had some of the largest volumes on the NSE yesterday. JP Power was limit up 20%. They'll come up on your screen. There was PC Jeweler. There's some buzz, by the way, around this one. And there is Ratan Power, which also was up big time. I think 1, 2, 3 in terms of volume-led gains yesterday. Amnish.
It is not fair to give any view of any of these because some of these companies, they have seen very sharp moves in the past few months. But till the time one is very sure on the numbers, I think it's playing with investors' money.
Yeah, no, never. I don't know if you picked up anything. My question was more in that sort of, on that line in terms of if you picked up in terms of news flow or anything of that sort. But all kinds. Market, of course, buzz with all kinds of stuff which has been going around. These amine stocks from the chemical space, some niche have also done very well. Actually, last 6-7 days now, Balaji and Alkyl. Do you track these?
Yeah, I think we might be looking at some of these names.
So, Amnish, which within the specialty chemical space, specifically, which ones do you like?
See, I think we have got very few likings if you look at, say, the specialty chemical space, because this entire scenario of China plus one and all, it has not played out the way it was earlier thought to be. So there are, I would say, not many stocks which can give you decent upsides from here on. So if you ask me about, say, the particular stocks, maybe you can look at, say, Navin Fluorine is one, or maybe I think some of the others. But our view on the chemical stocks is very mixed as of now.
Acha, mixed view. Navin Fluorine, by the way, is also raising a QIP, so stocks in focus in any case in terms of today's trading action. The first of the pre-open rates have started coming in, 80 points down on the Nifty. That's the first rate, 82 lower. You can see there at the bottom of your screens. There we go. That's the Nifty. Look at the textile stocks. Gokuldas in the pre-open is up 5.5%, 6%. And it's a bit of a no-brainer of a trade, purely from a trade point of view, perhaps that's how people are looking at it. But in terms of real benefits, like Amnish says, we need to know that what the final tariffs are actually eventually. And then perhaps a clearer view will emerge. The Nifty is down. It's a little volatile, actually. Suddenly 180 points down. It's completely all over the place right now. So let's wait for it to settle and focus on a couple of stock names and news flow. We've got a lot of brokerage notes out on pharma companies today, and Ekta has been making sense of them for us. Ekta, good morning. So which ones caught your eye?
Well, I'll start with HSBC. That's written on Divi's Labs. They've upgraded the stock to buy with the target price raised to 7,900. According to them, the long-term growth drivers by tirzepatide, which is basically Mounjaro, other peptides and contrast media would be something to watch for. They see revenue potential of around $450 million from peptide and $260 million from contrast media by 2030. They forecast FY5 to 28 estimated EPS CAGR of 23%. Macquarie has written on pharma. They've said they've revisited the export-focused pharma. US generics market is under pressure. Price erosion is expected to accelerate due to fewer drug shortages. Revlimid generic is nearing end of exclusivity, which is by Jan 2026. Earlier than expected price erosion is likely to impact Q1 FY26 results for key players. Lower P multiples for US-focused generic companies amid changing dynamics is what they see. Aurobindo, they've downgraded to underperform. Dr. Reddy's, they've downgraded to neutral and cut the target price as well. Cipla and Zydus and Lupin, they've maintained their outperform, but they've cut the target prices on all three of these stocks. And Sun Pharma, they've reiterated an outperform. Minimal US generics exposure benefits their outlook on that stock.
All right, Ekta, thank you very much for that. So that's the call coming in from Macquarie on a bunch of pharmaceutical names. Stocks should be in action. Let's focus on one more name. This is Leela Hotels, recent listing. Mangalam has got more on this one. Mangalam, morning.
Good morning. So it's a recent listing, and a couple of their bankers, the likes of BofA as well as MS, have gone ahead and initiated coverage on the stock as the silent period between the bankers initiating coverage on the stock and the IPO has ended. So we have Bank of America Securities having a buy rating, a target price of 520 rupees. They believe that the overall valuation at 20x FY27 is attractive. 12 to 14% is what they're expecting in terms of revenue and EBITDA compounding over the next few years. And on a low base, the earnings grow over 90% between FY25 to FY28. Morgan Stanley, too, has initiated with an overweight rating. They have a target price of 549. They believe the only thing to watch out for will be the concentration risk, because a large part of their revenue comes in from smaller number of hotels. They, again, expect 12% EBITDA growth all the way until FY27, with net income from a low base increasing nearly 9 times as interest costs come down post the issue. We have the balance sheet, which is now nearly debt-free, leaving free cash flow to fund the upcoming capex cycle for the company. So those are a couple of things that they'll be tracking in Hotel Leela too.
Okay, all right, got it. Thank you very much for that, Ekta and Mangalam. And thank you, Abneesh, for all the calls this morning. Look forward to connecting again soon. But let's go back to that big story, global story. President Trump's tariffs and those tariff letters have gone. And once again, I reiterate the point as we introduce the next guest, that Asian markets are taking things in their stride. US futures are very flat. There's no major downside across Asia. In fact, markets like Japan, which are at 25% tariff, the market is actually holding up. So what is the interpretation of all this, and what does it mean for markets from here on? William Lee, Chief Economist and Executive Director at the Milken Institute, is joining in. William, hi, morning, great to have you on. I remember, just last week we were doing the global reset and you were there. And I think you're among the rare voices that perhaps feels that while tariffs will bring about a major trading and economic reset, it may not necessarily be a bad thing for the market. And that's the view that the market seems to be taking. I mean, a lot of these tariffs are not too different than what was announced for countries on the 2nd of April, and yet the market is not falling. What do you make of it?
Exactly. If you remember our conversation, I said the purpose of the tariffs was to initiate discussions and really accelerate them. Well, it looks like they didn't accelerate them, but President Trump, I think, has got in mind a restructuring of the financial system, the global trading system, in a way that allows each country to make a deal with the United States. And unfortunately, most countries are taking the attitude that we're still under the old rules of WTO, where lawyers take their lawyerly pace and it takes years to negotiate the stuff. Well, President Trump is very serious. He says, look, we have some tariffs that you will have to confront if you choose not to partner and trade with the United States in a way that makes sense to both sides. And what President Trump was trying to do was say, bring your investments into the United States, bring your production into the United States, bring your technologies into the United States, and we will give you a protective barrier of tariffs to protect you from unfair competition from other countries. But at the same time, you'll benefit with higher profits and higher output and higher sales in the United States. Unfortunately, very few countries have really taken him up on this offer. But I think President Trump is showing his patience as well. And I think that's what the market is really sussing out. And as I said to you before, the markets really are figuring out that we are in this process of restructuring. It's going to take time, but we need these framework agreements first. And right now, President Trump has sent out a bunch of letters saying, okay, you don't give me an offer, here's my offer to you, 25% tariffs. I think that surprised everyone by the fact that they were so low. But I think that's also President Trump's way of saying to everyone, let's talk, and let's talk now.
Make an offer you can't refuse.
Anyway, not too many can refuse. I think China is the only one that managed to refuse and say, hey, this is not how we roll.
I have a very important question, Surabhi, for William. William, good morning, Prashant. I'm scratching my head. What is the reason for fine-tuning of some of these tariff rates? Japan has gone from 24 to 25.
Well,
on a lighter note, go on, William.
Well, remember how he came up with these tariff rates, right? He said, look, it's not about tariffs. It's about not being able to get into your markets. It's not being able to get into the foreign markets. India included, by the way. And he said, it's not the tariffs that are bothering us that much. It's the non-tariff barriers and the fact that your markets just aren't open to trade. So let's have open markets. I think that's the objective of these discussions. Open up both sides and we'll both benefit. President Trump is not trying to isolate the United States. In fact, he's trying to engage in much more bilateral and regional trade. And I think that's the essence of how these tariffs are calculated, to say, look, the barriers that you have put up, tariff and non-tariff barriers, have resulted in these imbalances. So I'm going to give you the equivalent on our side, but let's get rid of this stuff and let's start to negotiate seriously.
Yeah, we are 6 minutes from market open, so maybe this is not maybe we'll do this another time during the day. I can make the opposite points to you, William. Actually, just look at what he's done. I mean, some of the closest allies, right? Japan, Korea, for 50 odd years. He's kind of that line that you said, he's not trying to isolate America, but the real practical effect of what he's announcing is exactly that.
Some of our closest friends have also been some of our most troublesome trading partners, including Canada. I mean, they're trying to protect the dairy industry. The Japanese are trying to protect their rice industry. Everyone's trying to protect their home turf in some way. And I think President Trump is saying, we acknowledge that, but let's try to remove as many of these home turf barriers as we can.
But William, to press on the point further, and at a level as we've all understood in the last 3 months, this is not entirely about tariffs or non-tariff barriers. It's about trade deficits. He doesn't want to run large deficits with a lot of these countries, which is a separate argument altogether. The reason the deficits happened is that because it was more efficient, perhaps, to manufacture in Japan and then ship to the U.S., or manufacture in China and then ship to the U.S., and that's what he's trying to turn around. We'll see if he succeeds or not. Yeah, go on.
He's not trying to get rid of the overall deficit. I think he acknowledges that Americans just consume way too much, right? And so that we have to live with the fact that we have an overall balance of payments deficit. Where they're distributed, that's the thing he's trying to shift with these tariffs, right? He's trying to shift the deficits to our friends and take them away from our competitors. And the point of a tariff is not to reduce the overall deficit, but it's to really reshape the distribution of deficit.
Yeah. So, okay, one final point, and I go back to our last week conversation where you said that this will have some impact on inflation, U.S. inflation, but may not be like all destructive. Now, see, if you're bringing in an item of clothing, a T-shirt from Bangladesh, the tariff is 35% now, which is a lot higher than what it used to be. So won't there be a serious inflation implication and therefore consumption and growth? What are the implications on the second half in the U.S. economy?
I'm going to look for, as an American shopper, those T-shirts that are not so much made from Bangladesh, but Mexico or other areas with lower tariffs, because they will sell at a lower price. And I think that's really the way American shoppers are going to substitute lower cost stuff for the high cost stuff. Now, some stuff I just can't substitute away, but I'm going to learn to live without avocados from Mexico. And I will try to find California avocados, or maybe use hummus. So I mean, there are substitutes that you can do, and I think that will contain the amount of absolute rise in U.S. inflation rate overall.
Okay, so William is not going to maybe not have avocados in the near future. That's one small takeaway. Okay, at about 9:12. So, William, very, very quickly, I think just 30 last seconds on to this conversation. India, amidst all this, would you be positive on the economy and the markets here?
I think India really is in that position of saying, we will open our economy. And now the question that President Trump is asking India is how, what sectors, and how much can we really engage in a bilateral trade that's beneficial for both.
All right, William, we'll leave it there. Thank you very much for joining us. Good conversation and some good banter as well. Appreciate it, as always, here on CNBC TV18. I think what we're going to do is just take a look at prices. I think we've come to the end of the pre-open session, but also get you some trades as well. So Darshan and Mitesh are back with us. So let's actually do the trades first. Morning again, gentlemen. So Darshan, you go first. What are your 9-10 calls?
Well, it's Bharti Airtel. It's a positional buy with a stop under 1989.
Okay, Bharti is Darshan's trade. Mitesh, what about you?
I'll go with a buy on Britannia for targets of 6,000.
FMCG, Britannia in focus for Mitesh. Gentlemen, thanks very much, both of you, for joining us at this point in time. I think so, surely, but slowly headed to the market open, which is again going to be a little quiet. And that has been true. Yesterday has been true, actually, the last few trading sessions as well. Absolutely nothing on the sensex, and I think very little on the nifty as well. Although names like Gokuldas, etc., which we highlighted with our research team in the morning, are higher, 4-5%. Will they? Will those rates? Okay, it's almost 7% now on Gokuldas exports. I mean, that's become kind of the go-to stock to express a view in terms of what's happening with textiles. Apparels actually is what Gokuldas does, and US, of course, is the single largest geography into which bulk of its products really go into.
Just one more stock, Prashant, I wanted to highlight as we get into the open is Titan. Titan's talking about roughly, I think, 18% jewelry growth for its 18% growth for its jewelry business. When the smaller players are still growing, right? Senco, Kalyan, they're still talking 25% plus kind of growth. So this is also something that the market will have to perhaps contend with. And big stocks like Titan, market always wants more, perhaps.
Absolutely. And I think, the 2.5% cut shows that. We'll sort of address some of this with our market master who tracks consumption pretty closely. Gautam Duggad will be joining us in just a bit. We'll do market open, then go across to him. So we have the first rates which are starting to come up any time now. Indices first, and of course, we'll look at specific stocks, etc. Yesterday, of course, was all quiet except maybe FMCG as a space. So there you go. Nothing very much. 25,444 on the Nifty. The Nifty Bank is just sort of settling down, but that doesn't amount to very much. At least the open, 57,000 flattish open there. You've got the mid-cap index, which is up down 50 points, 60 points, 59,455. And the small-cap index, which will come up on your screen as well. And they're about a 20-odd point change. So again, it's absolutely flat. A little high, skewed to the positive side, the advanced decline. So 1,050 higher out of the gates, but this will change 600 stocks lower. Yesterday, the market breadth was negative. Numerically, the number of stocks, if you just looked at what was up and down. Heat map more down than up, but not a lot. So 25,446 is where the Nifty is starting at, about 13 points, 15 points lower. Sebi.
Okay, Titan is not sparkling this morning. Look at the cut on the stock. It's almost 4.5%. That is the big news and the big mover of the morning. Titan, the issue being this 18% growth in the jewelry business. The market is not happy, and some of the notes are pointing out that the base was also relatively lower. So on a lower base also, if you're not delivering faster growth, then it's a problem. So that's the one big headline. Other than that, on the weaker side, some pharma names, Dr. Reddy, Cipla, Sun Pharma. So pharma is a little soft this morning. These stocks are down about 0.5% each. There is some weakness on ICICI Bank, on L&T, on TCS. These are some of the heavyweights which are all dragging on the lower side. But now let's see what's up. Kotak Mahindra Bank reacting very well to its Q1 updates. Kotak is the best stock on the Nifty this morning, 3.5% higher. Tata Motors actually reacting positively. Perhaps, the market taking that JLR weakness in its stride, not as bad as expected. Eternal, ONGC, Wipro, and Jio Financial Services. These are some of the other stocks moving. But with all of this put together, Nifty is moving a grand total of about 13 points at this time. 13 points lower this morning.
All right, there should be a couple of stocks, though, that are in focus. J&K Bank, that's one of the big volume gainers this morning, so that's doing pretty well. Titan, as you said, was under pressure, but it seems that on PN Cargill, at least the start is in the green. The retail segment revenue growth has been closer around 19.5%. So, that's doing a relative outperformance, is up 1% or thereabouts. Phoenix Mills, well, a mild green tick is what we're seeing. The quarter-one consumption is up by closer around 12%, and the occupancy as well at around 89%. Nectar Life, that's the one that's the big loser this morning. We've got, that announcement that came in earlier today. They'll be selling their API formulations and menthol businesses for around 1,290 crore rupees. For the time being, I'm not sure whether it's valuations or the street doesn't like that deal or it ran up ahead of it. But that stock is clearly one of the big losers this morning, down close to around 15%. And aggressive selling is what we're seeing on this front. But the sector of the morning has to be textiles. Gokuldas exports flying away up 5.5%. Welspun India as well, more to do with the tariff news that came overnight rather than the Wimbledon tulls. So that one, in fact, has also opened up well in the green this morning. So that's, I think, the sector to watch. Let's pull up a couple of paper stocks. I think JK paper should come up for you. These stocks actually had a big run in Friday's trading session. I'm not sure whether they're doing too much this morning, more or less flattish as we speak. So,
I just wanted to point out Kotak Mahindra Bank as well and just revisit those numbers and look at the growth, scintillating growth from Kotak Mahindra Bank in the first quarter. 14% up on advances, 14.6% up on deposits. The CASA ratio has been improving as well and 4% higher. So wherever there's growth, the market is willing to take up notice and salute the stock. That's what Kotak seems to be looking at today.
Well, that's Kotak Mahindra Bank. 22.31 is where Kotak is at this point in time. Gautam Duggad is with us, Head of Research, Institutional Equities at Motilal Financial Services. Gautam, welcome to the program. Good morning. Thanks very much. Prashant this side. Let's just start with what we've been talking about since last Friday. which is consumption, FMCG, but consumption broadly. And many have been sort of on the sell side pushing this theme, but it's not worked yet. Maybe it worked yesterday. It's been fleeting, to put it mildly. What is your sense? There are lots of factors aligning, and I think we know all of them. Perhaps this GST rate realignment, that 12% slab, perhaps will also help along with everything else. But what is your view? Will this part of the market make one money? And where exactly?
Hi, Prashant. Good morning. Thanks for having me. So when you talk about consumption, it subsumes so many sub-segments that it's very difficult to take all of them and paint them with one brush. So what has been happening over the last few years is that the low-ticket consumer staples has been struggling. And they've been struggling for last 3, 5, 10 years, not a recent phenomenon. Of course, it got broadcasted more recently. But if you look at the last 10-year compounded sales growth of many of these consumer staple names, hardly one company or two company at max, if you stretch, would have done a 10% top line CAGR. And I'm talking about top line, not even volumes, right? So, and of course, the last 3-5 years have been very, very tepid. In fact, I won't be surprised if there are many stocks you will find which would have given zero returns on a 5-year basis. Like the bellwether stocks have done nothing. So what has actually happened is, within the consumption space, the higher ticket discretionary goods, they've done far well. And which is where our stance has been for last 4 years now. And we are continuing with that stance. In fact, yesterday when we published our strategy preview for this quarter, we've made consumer staple weight 0 in our model portfolio. We had a single stock as it is, that also we've removed. So all our consumption allocation in the model portfolio now resides in discretionary. We feel as we move from $2,800 per capita to somewhere close to $3,500, $4,000 over the next 4 to 5 years, the alpha that you will generate in consumer discretionary stocks will be far better than consumer staples. In fact, consumer staples volume growth, there can be some episodes of few quarters where the volumes might go up to 3% or 4-5% here or there. But from a slightly longer term perspective, I think the alpha and the absolute returns that you can generate in discretionary will far outweigh what you will get in staples. Having said that, staples will obviously provide downside support in a volatile market when market is in a corrective phase. But I don't think we are building portfolios for those kind of markets. So our stance remains intact. We prefer consumer discretionary or consumer staples.
Got that. Gautam, hi, morning, great to have you on. I remember that in your model portfolio, I think Titan is a stock that you've liked for a long, long time, right? Yeah. Now, when we talk discretionary consumption, even there, the market is hungry for growth. And say, for instance, I mean, if you just talk about the jewelry space, there are other companies, smaller companies like Kalyan and Senco. They're managing to grow at 25 or 30%, but Titan, I mean, at least this quarter, they're talking 18%. So what is happening with this industry bellwether? Is it just a temporary sort of realignment of sorts? Because the market's mood changes very quickly. And we're seeing some of that play out this morning itself, that they're hungry for growth, they might as well go for tier 2 jewelry stocks. What would your advice be to investors in this sort of situation? Trent is another classic example, right? Great company, great pedigree, but from a 50% growth rate, now they're doing 20%. And we remember how badly the stock was punished. So how should investors think about some of these high pedigree, marquee leader stocks if the growth rate starts tapering down?
So, Sebi, just 2 points. On Titan, the size of Titan versus other jewelry players is 5 to 6x on revenues. And in some cases, even 10x maybe versus the smaller companies that you mentioned. So obviously, if those companies are growing at 25-30%, Titan's 18% is very respectable on that size. Plus, also remember the fact that 1Q FY26 jewelry prices, gold prices versus 1Q FY25, the underlying gold price inflation itself is more than 30%. So clearly, there is going to be some impact on volume here or there. Third, the sector's size is $80 billion. And sector over the last 10, 15 years has been very consistently and gradually transitioning from unorganized to organized, which augurs very well for all the organized players. And of course, Titan being the bellwether leader of that industry will stand to benefit the most from it. The reason why we are positive on jewelry and not just Titan, some of the other names like PN Gargil, etc., is the fact that the size of the industry, the TAM, gives us confidence for a very long runway of growth visibility. today also, organized is hardly 40 or 45%. And if you go by the demographics of India, which we discussed extensively in your last Friday's editors roundtable, we have a very young demographic where wedding will continue to happen. And out of the 650, 700 tons of annual demand of gold in India, around 55 to 60% is wedding. So this industry offers tremendous growth visibility, of course, with a lot of intermittent volatility, depending on how the underlying gold prices behave. So we remain very, very positive and constructive on jewelry. Titan has been our long-standing top idea in not just jewelry, but overall consumer discretionary space. And our view has not changed. Coming to trend, that is where we've had a tactical positioning change in our model portfolio now. We've replaced trend with Jubilant FoodWorks. As you rightly said, for a company which is trading at 110, 120p, there's absolutely no room for error. I mean, if you view it in isolation, 20% growth on top line for trend looks very, very respectable compared to what the peers are printing right now for last 2-3 years. They're struggling to grow even at 8-10%. But the fact is, trend trades at triple-digit PE. So expectations embedded in that stock price were of 25 to 30% top line growth on a minimum, right? So therefore, 20% growth will look like a dampener vis-a-vis the valuation that it is commanding. So we think that it'll take a couple of quarters, and more importantly, not just the growth. We were a little bit surprised by the store additions for the quarter. Maybe there's going to be a bunch up, and obviously, whatever the annual targets are, they generally don't tend to be linear, more non-linear in nature. So story remains very intact. If I were to take a call on 3 years, there is absolutely no doubt that trend will form a very respectable allocation in my portfolio. But from a near-term tactical 3 to 6 months perspective, we think there's going to be more time correction that is that trend might see.
Interesting. So, Trent makes way for Jubilant FoodWorks. That's quite interesting. Sorry, 10 seconds. I'm taking from Nigel's time, but just 10 seconds. So, Jubilant FoodWorks, I mean, QSR, is that the only stock, or overall have you turned very positive on QSR? Quick 10 seconds, and we need to move on to other sectors.
So QSR has a very favorable base, plus incrementally, we think urban consumption is about to revive for a variety of factors that you already mentioned. And that's why Jubilant, being the only company with great market share, excellent delivery on cash flow, and a strong balance sheet, we think it's a small sector ultimately. You can't have too many stocks of QSR space in the model portfolio. So we chose the best one that we thought.
All right. Hi, Gautam. Good morning. Good to see you. And as always, let's talk about earnings then. Earnings season is going to be upon us in the next few days. Results will start trickling in. Q4 was great, actually, because expectations were so weak and then muted. And then suddenly, in fact, it looked better than expected. This time around, in terms of earnings growth, what are we factoring in? And for the year, what are you looking at in terms of Nifty EPS growth?
Good morning, Nigel. So yes, you rightly said, fourth quarter was the best quarter of last year in an otherwise very tepid full year FY25, which turned out flattish after 4 years of 20% plus earnings compounding in Nifty and close to 30% earnings compounding in Nifty 500. This year is looking much better compared to FY25 for a variety of factors. Government, RBI, lot of things have come together and they've given a lot of pro-growth measures, be it rate cut, liquidity, income tax cut, monsoon is good. So we think FY26 earnings will be far better. We are working with an assumption of close to 11-12% earnings growth for full year. To begin with this quarter, we are expecting 10% earnings growth for our coverage universe and about 5% for Nifty, which essentially means that as we progress into the subsequent quarters, and because we always prepare 4-quarter breakup right at the beginning of the year, the next 3 quarters we are building in about 13, 15, and 16% growth for our coverage and 6, 12, and 15% for Nifty. So as we progress further in FY26, I think the news flow around earnings will turn far better. Second, a lot of sectors are contributing. Last few years, we have gotten used to few sectors driving the growth. The interesting thing in FY26 and more particularly for 1Q FY26 is that the smaller sectors, which have hitherto not contributed much to the earnings growth, they are joining the party. So sectors like cement, sectors like retail, they are coming and printing more than 20% kind of earnings growth this quarter. Whereas the bigger sectors, auto, BFSI, IT, pharma, consumer durables, they're still struggling in that 4 to 8% kind of growth band right now. We expect financials to become far better as we progress in second half. The benefit of rate cut and surplus liquidity will start manifesting in their numbers from second half. So net about 10% earnings growth to begin with for this quarter for our coverage universe.
Talk about some 50% upside stocks, Gautam.
And 25%.
And by the way, I'm not joking. I'm serious.
So I'll give you an option: either stocks with 50% upside or stocks with 25% earnings growth. I'm making it very simple for him, right?
Absolutely. So I'll choose Surbhi's question then. That's far easier. 50% upside stocks generally, Prashant, are known in hindsight. Just like
No. You give us 25% earnings stories, they'll give us 50%.
Absolutely. That's why I've chosen the easier path. Look, there are sectors like cement, EMS, where we are expecting very strong growth this particular year. Cement has struggled for last 2 years, and we are expecting pricing to improve, EBITDA per ton to grow 30% this quarter. While stocks may not have corrected much in FY 24-25, despite very tepid earnings, but as you start seeing print of better earnings there, and of course, the underlying macro on consumption, capex spending by government has also given a bit of a hope. If you looked at the March and April number of government capex data, so cement clearly looks like a good bet. Second, EMS, there we are continuing to see not 25% but 50-60% earnings growth. Very difficult to find this kind of stocks in other sectors given the environment that we are living in. So if you look at it from a very top-down perspective, Prashant and Surbhi, we are slowly transitioning into an era where the nominal GDP growth itself will settle at 9-10% band now. Because you've gotten a control over inflation. We are talking about 3.5-4% inflation and roughly 6.5% GDP growth. So nominal GDP, if it settles in 9-10% band, very difficult for corporate India to print more than 12-13% earnings growth in this kind of a environment. With that, of course, there will be a lot of stocks which will compound at 20-25%. There are stocks in retail sector where we are seeing more than 25% earnings growth for FY26. Then there are some pharma names, some consumer discretionary names, obviously, that we discussed about. So there are many stories out there for bottom-up stock picker and asset allocators to find that.
You mentioned Jubilant Food, Gautam, out of the, just completely published, nothing non-published, out of cement, EMS, etc. Which are those names?
So for example, in EMS, we are very hot on Dixon and Kate. Both are there in our model portfolio. So they have benchmark 0 allocation in the benchmark indices. We have 4% allocation, right? In discretionary, as I was discussing with Surbhi a few minutes back, we have Titan, we have Indian Hotel. They've been part of our model portfolio for many years now. We have Page, and we've added Radico Khaitan. Again, very strong earnings growth there. Last 5 years, they've compounded earnings at 35%. Next 3 years, we are expecting 25% plus earnings CAGR. That finds entry in our model portfolio. And of course, we have Page also. So there are a variety of names. In fact, Prashant, while at it, I must also mention that we have increased the weight on mid-caps after a long time in our model portfolio. So till April, we had 76% allocation to large cap. We have brought it down to 69% because the mid-cap earnings are looking very strong. Last quarter, our mid-cap portfolio of 93 stocks delivered 26% earnings growth or 22% earnings growth. This quarter, again, we are expecting 21%. And as we progress for the rest of the 3 quarters, our expectation are 10, 25, and 20%. So mid-cap earnings are outperforming large cap by a margin of 2x. And therefore, while we keep debating on valuations, and valuation premium is there, everyone can see it, and it's been there for more than 3 years now. If this kind of growth continues, it's very difficult to imagine that that premium will.
And what are the new additions on the mid-cap side, Gautam?
So there are quite a few additions there. Jindal Stainless is something we've added. UTI AMC is a new stock. As I mentioned, Radico, Jubilant, they are new additions. We've added Lodha, Macrotech basically. We've added Niva Bupa. So quite a few allocations, new allocations. And of course, we've also gone, we upgraded our stance on auto, like we discussed a few months back. That auto is offering you a combination of reasonable valuations and modest expectations. So while we have not changed our stocks in auto, we've increased the weight on both M&M and TVS, which were already part of the model portfolio. But auto moves from underweight to equal weight now.
Very interesting. So auto moves from underweight to equal weight. And that's largely because of your focus on auto ancillaries, or just expand on that? Because again, auto, for the longest time, like FMCG, has just failed to enthuse. FMCG, you're not changing your stance. You've explained that. Within auto, what are you turning positive on now?
So auto, we already had M&M and TVS in our model portfolio for some time now.
Which have already done well, Gautam. But anything new?
We expect it to do better now. In fact, this quarter also, if you go into the details, you will find that out of the 26 auto stocks that we are covering, The two best performers for this quarter in terms of earnings growth will again be M&M and TVS. Rest of the stocks, Maruti, Hyundai, Tata Motors, Bajaj Auto, they will print a negative earnings growth again in this quarter, right? So we are quite lucky to have chosen the right stocks even when we were underweight on the sector. So you're not changing the stock calls per se. Insofar as auto anchors are concerned, we think Craftsman, Endurance, and Happy Forging are the names where we have a slightly positive bias. But the change in stance in auto is primarily dictated by top-down trends where valuations are still reasonable, expectations are modest, and underlying trends on monsoon, income tax cut, inflation, all of them are giving a signal that at some point of time in next 1 or 2 quarters, things will start looking better for auto. So we are positioning for that.
Very quickly, Gautam, no conversation on the market can be complete without discussing defense, right? And the next company that we'll be speaking to is Astra Microwave from that sector. So just very quickly, your thoughts. Prices have run up, but the order books are coming. Big order announcements are still coming. What's your advice to investors on defense?
We continue to like it. In fact, we've added Bharat Electronics now in the model portfolio in place of ABB. We also like Hindustan Aeronautics. The problem, however, is the stocks have run up too fast. What was our target price when we initiated HAL in March for 12 months was achieved in 1 month. In fact, as we keep highlighting this, the total market cap of defense went up from somewhere about 1 to 9 lakh crores in a matter of 3 years. And July 24 was the peak. Between July 24 and February 25, it came down by 35%. And then between February and June itself, it recouped all its losses and crossed the all-time high market cap. Right. So opportunity is tremendous. The focus of the government is there, and kind of geopolitical turmoil that we are seeing in the world, this sector will definitely merit attention. Just that one has to be patient and shouldn't expect a quick buck here. So if one has a 1 to 3 year horizon, I think we can still make money here.
But long term, yeah, don't look at quick gains because that
valuations have gone up substantially over the past 3 years, and more so post Operation Sindoor and rest of the geopolitical events that we have seen unfolding in the last 3 months.
Absolutely. So a little bit of caution perhaps warranted. Great conversation this morning, Gautam. Thank you so much for joining in. So we are, all excited for the earnings season, and the expectations are that this is going to be a good one, and maybe we get out of that single-digit growth funk that the Indian market has been in FY25. Well, let's then continue that focus on the defense sector. Astra Microwave is the company on our radar. So let's figure out what the business prospects are looking like. There's a huge increase in procurement. They, of course, look at the space segment as well quite carefully and closely. We have Mr. Atim Kabra, Director Business Development and Strategy at Astra Micro, joining in. Mr. Kabra, great to have you on. So I just want to start with the focus on the defense part of your business. Just last week, we've got another big headline announcement, right? That the Defense Acquisition Council has approved proposals worth 1 lakh, I think 5,000 crores thereabouts. So in the new proposals and the replenishment program that's ongoing for the government, do you see any significant potential for you? Because you've told us, I'm just repeating, your FY26 revenue target, I think, is about 1,200 crores, which would be roughly 20% growth. Would you look at increasing this estimate, given the pace of replenishment that the government is speaking of now?
Hi, good morning, everybody. Good to be back. I think the government has done its part. Now the industry has to step up and deliver. A delicate balance has to be maintained between timely deliveries in an industry which has slightly longer life cycle, and homegrown tech supplemented by outsourced pieces which are missing tech pieces. So our numbers will go up, obviously, as the orders from what has been announced flow down into the picture. And but more or less, the larger programs which have been defined, they are already taken into account in our estimates. But we will add them to our order book as the orders are translated into reality.
So as of now, you're not looking to increase your estimates for the year. That's 1,200 crores of your revenue target. FY26 order booking target is around, I think, 1,400 crores, if I have the latest numbers. You're not looking to increase those numbers?
The announcements have to result in the orders going down to the the customers, and in turn, they will place orders onto us, right? And these are slightly longer gestation projects, so it takes time to actually for the cycle to flow down and translate into real numbers.
No, fair enough. But what the DAC announced last week, this was last Thursday, Friday, where they're talking about quick reaction surface-to-air missiles, all kinds of other, systems and subsystems.
Yeah.
So what is the opportunity size for you from that huge number of 1 lakh crore that was announced?
When we talk about, for example, QRSAMs, right? QRSAM, Astra will get about 1,800 to 2,000 crores, which we have disclosed in our analyst interactions. When you look at newer missiles coming in, if you have passive homing heads, which we are making, we are into missile electronics. Akash missile has been, we have supplied crucial subsystems to that. So space allocations, as you touched upon, right? Okay, there's in-space tender, which I think there are 4 or 5 consortiums which have bid for us, and we have bid. We are part of one of the consortiums. So these are all big picture programs which will translate into numbers as we go forward. So the order book will be increased in actual numbers as the orders are booked into the company. These are announcements of allocations which have been made right now. So,
all right.
Yeah.
Mr. Kabra, just to reconfirm on the quick reaction surface-to-air missile, the potential order that you'll get is how much? And the order will come in from BEL, right?
Yes, please. We will get between 1,800 to 2,000 crores. That's our estimate on the QRSAMs.
And
supply chains need a lot of time to be perfected, right? So these are all things which allocation is made. Then the BL, which is the main agency for this, they will in turn now intimate their suppliers, etc., etc.
All right. And by when do you expect this to come about?
I think could be last quarter of the current financial year, or maybe spills over into the next quarter of the next financial year, first quarter of the next.
When you talk about an opportunity of 1,800 to around 2,000 crores odd, your current order book itself is closer on 2,000 crores, which would mean that effectively your order book could double. So the execution timeline for this particular quick reaction surface-to-air missile, which the order will come from BEL, the execution period will be how long?
3 to 4 years, I expect.
All right.
Yeah. The tech curve now is very steep, right? And it's the short end of the time scale. So we expect that more and more such programs will be coming up, which have a very crucial tech element. So where there's a huge barriers to entry for people who are not part of the supply chain or the development cycles. So we are fairly well placed.
So this is very, very significant, Mr. Kabra. What you're telling us is that almost 2,000 crores of orders could be flowing into you by maybe end of this year, if not early next year.
Yes.
Very, very significant. And this is just the QRSAM program that we've discussed.
Yes.
What about, say, radar systems, unmanned aerial vehicles, other aspects of defense where you're active? What else is happening there?
See, it's basically the war is now tech-driven. The government has done its part. Industry has to step up. We are talking about, do we have the complete tech elements built in from A to Z, right? So there has to be assimilation of the missing pieces of tech which have to go in, and it's not about just modules which are being procured and put together, right? So you have to go down to the base components wherein you will actually break up the products, the tech pieces which you are maybe outsourcing and procuring from outside, add them to what you have and create solutions and products, right? So this is an ongoing exercise. There are a lot of programs which are coming up, but as and when they are adopted, the airborne platforms, all the fighter planes are being upgraded.
No, again, we were sorry, sir. I'm rushing you, but because our next guest is also waiting. But we were again just trying to understand the opportunity size for Astra in particular. So obviously, this QRSAM program is going to be massive for you over the next year and a half.
Yes.
Apart from this, when you talk about other defense components on the electronic side, on the radar side, are you expecting any other, big orders to trickle in? What else could be a contributor to your defense revenue?
If Atmanirbhar Bharat prevails, if the DRDO designs on, let's say, Su-30 plane upgrades, if they prevail over other technologies on offer, then Astra is very much a part of the Virupaksh radar program. Okay, so we hope that itself will be a very, very big chunk of business for us, because there are more than 230 Su-30s which will need to be upgraded. So there are MiGs which need to be upgraded. So airborne platforms are one. Radars are the backbone of modern warfare, as you very well know, right? So there are multiple radars which are being constructed at this point in time at various stages. You have triple LWR, the low weight, long range. Triple LWR. These are the radars. Bird detection radars are in the offing. The counter drone radars and.
What could be the potential business opportunity, sir, from this?
It's very difficult to put a number onto it.
Want to put a guesstimate?
These are all programs which will contribute substantial chunks of business every year. 300, 400 crores coming in lots every year, right? As you look at that.
All right, Mr. Kabra, very quickly before we let you go, everything's looking good from 1,200 crores. Probably in the next 3 years, you could do 2,400 crores. Probably double your revenues. Margins could be healthy as well. So give us a few numbers. In the next 3 years, where do you see your revenue move from 1,200 crores in this year? Where do you see it move? But more importantly, I wanted to ask you about your working capital days. That's got stretched very much. Cash conversion is very, very high. Tell us whether these numbers stabilize that, sir. Please go ahead.
The industry is capital intensive, right?
Yes.
There's no two things about this, right? But you have to also remember that the biggest chunk of orders, they are released in the last quarter, right? So
yes,
you may do whatever, but those orders will always reflect in your books as receivables, right? So as your sales grow, your receivables will keep growing. Right. So the year-end number of March 31st is a function of the fact that orders are released in bulk in the last quarter, right? But capital-intensive nature of the business is there and will remain. So if innovative ways of financing can be thought of, that's something which will ease. But otherwise, this is GOI credit, right? Okay, the banks should be more than happy to finance this. So we are not looking at this being a concern, but we need to manage our books very judiciously, the cash flows.
Okay, all right. We'll get into further detail when you declared your quarterly numbers, sir. For the time being, though, the street likes what you've had to say. The stock actually has moved to the high point of the day. We look forward to having a longer chat with you, Mr. Kabra. Well, let's focus on the consumption space. FMCG stocks are showing an uptrend as green shoots are becoming visible in consumption. In fact, FMCG companies have come out with fairly positive Q1 updates. So is demand recovery here? And what are the trends visible inside? To help us out with that, we're joined by Mr. Mayank Shah, the Vice President at Parlay Products, as well as Vishesh Dora, the Chief Growth Officer at Bizoom, who joins us. Hi, gentlemen. Good morning. Thanks a lot for joining in. Mr. Shah, you go first. Tell us, how are you reading demand on ground? First of all, break up your mix for us between urban as well as rural. How is consumption on ground? And are you seeing a good revival?
Firstly, if you talk about the contribution of rural, if you look at our product range, almost about 55% of our turnover comes from rural. So in terms of our stakes in rural, we have a substantial stake in, rural India. As far as consumption is concerned, we are seeing, good demand coming in from rural as well as urban India. So as we all know, last year was a little difficult one for FMCG and urban demand was under stress. But thankfully, we've seen revival happening in the first quarter of this fiscal, and we've seen, urban demand reviving. We will see, further revival of urban demand as we go forward. And rural continues to be, strong. So we continue, we see continued strong rural demand. Given, both urban and rural good demand, coming in, we're expecting a good year this year.
All right. What would good be, Mr. Shah? What is the industry growing at and what are you growing at? Have you gained market share?
Yeah, we gained market share last year. Last year, if you look at the industry grew at about 5 to 6%, mid-single digits. We grew at high single digit at about 8 to 9%. And that, gave us almost about 80 to 90 basis point increase in market share. If we talk about this year, current year, we're expecting, as far as the category is concerned, at least a lower double-digit growth. We are expecting at least 12-13% growth coming in, despite of the challenging situation as far as the input costs are concerned. So if we talk about crude, we've seen, spike in crude, although it's gone down now, but some challenges remain. So given, last year was difficult as far as input costs are concerned, there was, for the most part of year, it was very inflationary. And if that sustains this year, then, that would be one challenge that we would be facing almost all food companies or almost all FMCG companies.
Guys, guess what? We could do so with some biscuits here to go along with the chai right now. I think,
Consumption.
Well, a hint to the PCR team. Maybe. But gentlemen, thank you very much for joining us, Mayank and Vishesh. I just want to, Prashant here, I just want to ask both of you this one question. Many have made the point that actually it's not consumption which has been weak. It is just too much competition across product categories. An intensified competition, especially over the last 3 or 4 years. Mayank, would you agree with that? Or you think it's a combination of both? Or it's basically, it's we're talking about different categories. So, in some categories that could be the case. Others, consumption itself has been very low. What would you make of it?
That's partially true. So, regional companies are growing, smaller companies are growing, and they're definitely giving, run for their money to the bigger companies. However, if we talk about Indian market, I think, in terms of penetration, in terms of per capita consumption, I think we have a long way to go up, and that's something that, probably is the reason why you'd see that, most companies are very optimistic when it comes to, capex and other things. And not just that, even in terms of, growth and consumption, we're seeing a continuous increase and a continuous, growth coming in as far as, certain categories like foods and, few other categories, adjacent categories are concerned.
Okay. Vishesh, same question to you.
I think
yeah.
I think largely great products are winning is what we've been seeing for the past couple of years. Of course, consumer sentiments are moving towards different kind of products. Distribution, of course, is a key node to win the market, but great products are taking the forefront. When you talk about, is consumption lagging? I don't think it's lagging. It's continuously growing. And we've been seeing great indicators of it, especially in urban. Right, large pack consumption is growing, out-of-home consumption is growing. Your smaller packs are not growing that well in urban. Premium categories are penetrating deeper, right? So urban market is set for a great revival of consumption is what we see.
Morning, gentlemen. Vishesh, particularly want to address this question to you. The big debate that's out there that says that really D2C has disrupted perhaps structurally, that huge distribution mode that a lot of FMCG companies had enjoyed, especially I think in things like personal care, right? Where consumption is happening through your Instagram and ordering is happening through that channel or through, the quick commerce sites. What would you say to that? I mean, the effects of quick commerce and the way we will see volumes play out and just competitive intensity play out in the staples space.
I mean, if we still compare the vastness of the nation, D2C is still early in penetration. It will truly lie on how they scale offline. Online penetration of e-commerce is still, lower single digit, if I may say so. Right. So we are seeing that impact in urban, where great products, again, like I mentioned, are winning. Young brands who are investing into consumer-centric products. What we also see on the other side is large brands also adopting faster, bringing in or entering into categories which are D2C heavy. But all in all, you have to be offline if you want to penetrate deeper into the Indian market.
All right, Mr. Shah, coming back to you then, if you could tell us, what is your absolute market share? You said it's improved by 80 to 90 basis points, and if you could mention the category as well.
Yeah, so as far as biscuits are concerned, we have about 29% market share. And if we talk about confectionery, which is also another mainstay that, we have about 15% market share. Within snacks, we have about 7% market share.
All right. And what about quick commerce? Has it affected your channel strategy? If you could tell us, how much does it contribute in your overall share, quick commerce?
Quick commerce contributes about 4.5% to our total revenues, and I think as Surbi was just saying, or she was checking, I think that's one channel that is making a huge difference. So while you talked about D2C is good for niche brands, very premium brands, but when it comes to value brands, or when it comes to categories which are deeply penetrated, I think the last mile delivery cost is something that's prohibitively high in India for most D2C brands to really succeed. I'm talking about value and mid categories. In niche categories, yes, you can do with that. Whereas when it comes to QCom is something that when you aggregate it, and when you have aggregators, it makes a huge difference. And if you look at the growth rates in QCom, we are seeing almost about 40-50% plus growth rates year on year since last almost about 3 to 4 years in QCom.
Okay, so gentlemen, as we wind down the discussion, we'll be happy to report that I think the Kirana channels are strong and they're thriving for most of the players, because we've got our biscuits. Prashant, demanded, and it has been delivered
that makes
right in the time in which the discussion is on. And there's not Q-commerce. This is a regular, general trade channel delivery, and it's working.
Since it's appeared so fast, I'm thinking, what should I ask for next?
Don't push it. We have to be satisfied with what we
I'll tell you in the break.
All right, gentlemen, thank you very much. Mayank and Vishesh, appreciate both of you coming in. Very interesting discussion, and hope we can do more of this to get a real sense, a pulse of what's happening on the ground across, a range of topics, really. We'll come back in just a bit from now. Our special segment, Quarter Se Quarter Tak. Kavaljit Saluja of Kotak Institutional Equities will join us to talk about expectations from the IT space that's coming up. Stay tuned.
Welcome back. Well, the next sector that we're putting the spotlight on is the IT space, and that's because it is time for the earnings season, and we are back here with our segment Quarter Se Quarter Tak, bringing you expectations from each sector day after day. Well, Rima kicks it off, of course, with the IT earnings. Rima, so is there any good news in store first quarter FY26?
Well, unlikely. So you're not going to see the usual strength that we typically see in Q1, because so far the visibility on demand reviving is very low. So let's look at the early indications from the CNBC-TV18 poll. Well, large caps are showing weakness while mid caps continue to lead the charge. This is the large cap picture, and as you can see, 4 out of the 5 large cap IT companies are likely to report a decline in their revenue. Commentary across the board is likely to reflect that while the macro environment hasn't improved in the last 3 months, the good part is it hasn't deteriorated. Now a little bit more about the guidance. Now, Infosys is likely to raise the current guidance. It stands at 0 to 3%, but they made acquisitions, and therefore that guidance could be upped. If the lower end of the guidance is raised from the current 0 to 1%, it's unlikely to signal anything positive. It's the upper end which needs to move on an organic basis. Now moving on to HCL Tech. HCL Tech too could upgrade the lower end of its guidance. So 2 to 5% may become 3 to 5%. But here is where the good news comes in. Mid-caps are likely to outperform, and very strong growth. Look at Coforge. That's been leading the charge in the mid-cap space, and we're expecting about a 6.5-7% kind of a constant currency revenue growth on a quarter-on-quarter basis. Persistent is close to about 3.5-4%, and that's been the revenue run rate, at least quarterly growth rates for Persistent over the last couple of quarters, 3-4%. That's going to continue. Hexafair and Emphasis also upbeat. So mid-caps are likely to report stronger growth, and this is led by some market share gains and favorable portfolio. For instance, a few mid-cap companies have a little less exposure to manufacturing. So that's the key, takeaway. Large caps weak, mid caps will continue. Now moving on to the stock price performance. As we've been highlighting, mid cap IT has underperformed. On a year-to-date basis, the Nifty IT has underperformed by nearly 17%. Valuations for large caps are similar to their 5-year averages. But then again, they've got muted revenue. Earnings growth is expected to be fairly muted for the large cap IT companies. So in that context, even if the valuations are not expensive, are they cheap? It's the mid-caps where you are seeing a valuation premium. Now, the mid-cap IT companies are trading at 32, 33 times PE on an average, about a 38-40% premium to large cap IT, which is at about 23, 24 times. But that's because the mid-cap IT companies are also likely to report stronger growth. With high valuations are coming strong growth expectations. So this is the EPS estimates for mid-cap IT companies over FY25 to FY27. We spoke about Coforge's strong top-line growth this quarter of 6.5%. Well, they're likely to report a 38% EPS CAGR growth over FY25 to 27%. Hexaware Persistent could see about a 20% kind of growth, much higher than the single-digit EPS growth that large-cap IT companies are going to report. Now, what to watch from TCS, because that's the first one off the block on the 10th. Well, constant currency is likely to decline by 1.5%. The what to watch, the company last quarter told us that the international revenue growth, that's ex of BSNL, in FY26 is going to be better than FY25. Do they hold on to that? Does that commentary get stronger? And one puzzling factor for all analysts is that, margin expectations are not going up. And this is despite reduced contribution coming in from the low margin BSNL deal. So why is that not happening? Why are margins not expanding for TCS? And also, if you remember, last quarter, they decided to defer the wage hike. So the timing of the wage hike will be watched very closely this time. Back to you.
All right, Dreamer, thank you very much for that. So very, very good explanation as far as the IT sector companies are concerned and what to expect. Coforge, top of the list. I remember Coforge last quarter as well. I think the stock moved 8-10% after earnings. Expectations are equally strong this time around as well. Kawaljeet Saluja is Senior Executive Director and Head of Research at Kotak Institutional Equities. Kawaljeet, good morning. Great to have you with us here. Thanks for your time. So let me just get straight to the point. In terms of stocks that you track the entire gamut of companies there. But with regards to exceptional performers in a weak environment, it's very, very clear. It is, 2-3 of these mid-cap companies. Why is that, Kawaljeet? And, can some of the larger players start to do this as well? What would you be focused on?
Large companies may not replicate the strength shown by mid-tier companies. They have a few things working in their favor. First and foremost is the portfolio mix in itself. As Rima did highlight that many of these mid-tier companies do not have manufacturing and relatively modest exposure to retail. So that will help their growth in the current environment. Second is that they have the benefits of lower size as such. And third is that they can use Gen AI in a lot more proactive way rather than think about the deflationary risk to the portfolio. So as long as you have the right leadership and these mid-tier companies, it's reasonable to expect that they'll outperform some of the larger companies as such. Large companies, of course, again, they have a portfolio challenge in the current environment. And of course, there's some deflationary risk of Gen AI that they have to take into consideration. So this divergence in the performance would continue.
Folks are just pointing out sometimes brokerage notes can have very interesting titles or even stocks. I remember Nomura's note, categorically from last week, they called out Tech Mahindra as a marquee sell. Like marquee, I thought would be something which would be, positive, saying a marquee name or whatever, but it's a marquee sell. But anyway, I think Kawaljeet actually likes Tech Mahindra. Kawaljeet, hi, morning. So that brings me to the overall question on large cap IT, because you still, like stocks like Infosys or TechM. What's the reasoning? What's the rationale? Because the companies, to be fair, have been disappointing investors on growth for a long time. And even in Tech Mahindra, that whole improvement of the margin trajectory, that seems to be just taking really long.
Well, I think they had outlined FY27 as the year in which they are going to get to 15% EBIT margin. I think they're pretty much on track here. So I don't think what the concern should be. I think even in the current quarter, even though their revenues would be muted, they will continue on the margin expansion trajectory. In a turnaround journey, what happens is that there's too much of emphasis on what happens in one quarter rather than the entire journey in itself. And if you look at Tech Mahindra, the kind of improvements they have, the changes they have made on the leadership, the internal process, the deal filter, the structuring of deals, the TCV, I think they're pretty much on the right track on the turnaround journey. And that gives us comfort, on the story as such. Now, of course, if you're going to live by the quarter, then yeah, maybe the current quarter may be modest in terms of revenues. But again, you'll have a decent margin performance here. It's just that overall makeup, we have to basically look at it. We are pretty much comfortable with our...
Okay. That explains Tech Mahindra, but sort of the bigger question on large cap IT, there's clearly, you have conviction on Infosys, maybe not so much on TCS. Both the companies have not really blown the lights out in terms of growth. What makes you still optimistic, and why more Infosys than perhaps TCS?
I think it all boils down to a top-down view on what happens to the overall tech spending. Like, let's say if you take a directional view that tech services spending would remain weak, the way it is right now, then the pessimism on some of these large companies is justified. But I guess, if the assumption is that at some point in time, the spending picks up, which our belief is that it would pick up, given that there's a lot of core modernization, data modernization journey still left in the large, for our clients. And I think that's something which many of these large companies will drive. You can basically expect, a reasonable growth. So at some point in time, there'll also be an uptick in discretionary spending. Our assumption was that things will start improving in FY 2026. Of course, that got scuppered with the tariff imposition, which means that normalization of the growth journey got deferred by a year. So now, within this context, what you have to look at is that which are the companies that are executing well, and which are the companies that can capitalize on the ensuing opportunities. And I think that's where our confidence in Infosys comes in.
Okay, all right, Kawaljeet, quick conversation today, out of time, and hope you join us as we review some of these earnings as they start to come in very soon. First out of the block, that's the IT pack, as always. Kawaljeet Saluja at Kotak Institutional Equities. We'll take a quick commercial break here. What we're going to do is come back, take a look at what's happening as far as markets go, commodities in focus as well. Stay tuned. Okay, welcome back. Let's shift focus to what's happening as far as commodities go. Manisha is here with what is top of mind. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm looking at metals as a sector because we've seen a decline continue across the screen for a second straight day, by the way. The month of June was good, but July really hasn't started on a very positive note for many of these metals. Well, one is the higher US trade will take effect from 1st of August. Now, it just keeps getting stretched, so there's no clarity, especially when it comes to copper. We don't know whether it's going to be in the same line as aluminum and steel, which are tariffed by nearly 50% there. So that also seems to be bothering the copper prices there. Also, markets are grappling with steep tariffs. Letters from US have gone to 14 countries there. It also has to do with the US dollar index, which is holding at around 97.5. Also weighing onto the markets. Strong US jobs data continues to support the US markets as well. So all of that has led to money shifting into other assets, and base metal prices have seen a bit of a decline. Take a look at copper then, and pardon me. Take a look at copper prices, and we've seen $9,800 onto that one. We did see $10,000 a ton also hit in the previous week onto that one, but that doesn't seem to be holding at this point in time. The copper stocks, if you look at those, have seen a very sharp decline. They just are at around 97,000, and we have seen copper stocks drop by nearly 64% from mid-Feb. even after that, the copper prices have not been able to sustain above $10,000 a ton there. And it's not just about copper. Take a look at aluminum, zinc prices. We've seen 2% of a decline for both of these metals for this week as well. Palladium prices have come off their 8-month highs as well. If you look at platinum prices, well, they fell 2% overnight and are off their 13-year highs. The kind of that phenomenal run that we saw in the previous quarter in platinum, where we saw the prices gain up by almost 50%, now seems to be consolidating, even coming off because of some profit-taking. The speculators also seem to be winding on their long positions, and that's very clearly seen because of the fundamentals as well. We're looking at production in South Africa. Mines continue to recover. Above-ground stocks stand at 9.2 million ounces, and that is equal to 14 months of above-ground global demand. So all of those factors also weighing on. When you look at the week-on-week, month-on-month basis in sense of many of these metals, platinum, palladium, copper, aluminum, zinc, all of them have come off their multi-month and multi-week highs.
Okay, all right. Thanks very much, Manisha, for that. Well, there's commodities in focus. We take a quick commercial break here. On the other side, it's a special segment. It's the economy. Trump's shot off letters to 14 countries announcing tariffs. Lata will be speaking with Robert Subramanian of Nomura and Chandresh Jain of BNP Paribas and the impact of these tariff letters on economies, currencies, rates and more. Stay tuned.